Okay, everyone. It's actually about 20 minutes after 9. We just got done with the first webinar for the Dallas attendees, and for those of you that are watching this that were in the room, you're probably chuckling to yourself because you realize that after all of our struggles to get the audio working in the room, the audio did not show up on the recording. So I had just about an hour's worth of video that was dead, total silence. So what I'm going to do here is recap what we went over in that live session, and but I'll do it in a way that's a bit more condensed. And really, what I wanted to do this time around, anyway, was cover the very basic elements of the trading system we went over in Dallas. Okay. Now, the reason why I want to do that has to do with the number of emails and phone calls that I've gotten over the phone calls that I had this past week and the emails that I've gotten since the event and since returning from vacation. It's obvious that a review is necessary. So we'll go over the basic stuff here first, and then Wednesday we'll go over, we'll review the basics, and then we'll start diving into some of the more advanced techniques that we touched on at the live event. So first of all, you have to remember that there are two main parts of the trading system. There's the weave, and then there's the trend. The reason why we look for the weave has to do with the way markets like to trade. Okay? Let me just kind of zoom out here. And as you look at trends, and as you watch price move, what you'll find is that, especially when there are really big trends, you'll get price moving quite a bit, a sideways chunk, and then you'll get another move. That's very, very common. Also, when the market is just sort of mucking around and going sideways, you'll see here that when the market isn't really going anywhere, before you have a large move, you'll get the moving averages weaving together. Let me give you an example. I didn't show this in the live session because I didn't zoom out this much, but I think it's a very good example. First of all, I know this is going to touch on an area that I don't normally like to, in an area I don't normally like to go, and that's predicting. I don't think you can predict with 100% certainty the direction of the market, but I think you can get a good idea of if the upcoming move is going to be a big one or not. And I think the best way to do that is to look at the weave. Okay, now I'm going to zoom in on a couple of areas here. Now I want you to look at the moves here. Okay, I mean they're pretty big. Okay, you've got several hundred pips in here from top to bottom, but there really isn't much of a trend. What you can notice as well is, except for this first area here, the moving averages never started to weave or didn't weave all that much until you get to the area right before the big break. Okay, so let's highlight on a couple of areas. First of all, notice that the moves aren't that big, right? But before the biggest of the moves, okay, so you have this move here, this move here, this move here. Okay, these are the largest moves. Look at what happens to the market. You get the weave here, get the weave here, get the weave here, get the weave right there. Right before the market makes its move, the moving averages start to weave together. And that's nothing more than where you have a moving average doing this and another moving average doing that. They're crossing, crisscrossing. They cross it here, 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 again and again. Now, hopefully you can see, let me zoom in a little bit more. You can see how they start coming together, okay? There's moving average moving like this,